If you want my honest view, most people ask the wrong question when they compare ETFs. They ask which one beat Boo last year. That is the question of a spectator, not an owner. The right question is this: what kind of machine am I putting my life savings into, and what will that machine likely do for me over a full cycle through panic, greed, recessions, bubbles, recoveries, and the ordinary boredom that destroys more portfolios than any crash ever will? I have watched people spend more time choosing a vacation hotel than choosing the core positions that are supposed to carry them through the next 20 or 30 years of their financial life. Then they act surprised when their money behaves like a confused tourist. I am going to tell you something that will save you a great deal of pain. Your core portfolio is not the place to entertain yourself. It is not where you prove you are clever. It is not where you chase whatever made the loudest noise over the last 12 months. Your core portfolio is your economic operating system. If that operating system is weak, expensive, concentrated in the wrong places, or built on excitement instead of endurance, the rest of your financial life becomes harder than it needs to be. That is why when I look at an ETF, I do not begin with the story. I begin with the structure. What does it own? How much does it cost? How long has it been around? How did it behave when conditions were favorable? How did it behave when conditions were ugly? How quickly did it recover? And most important of all, what kind of owner does this fund quietly train you to become? Most people miss that last one. Every investment teaches behavior. Some investments teach patience, some teach greed, some teach discipline, some teach restlessness, some make you richer in a decade, some merely make you busy, and busy is often the most expensive mistake in investing. The file you gave me circles around a useful idea. History does not guarantee the future, but it reveals the temperament of an asset. That matters because you are not just buying returns, you are buying a pattern of volatility, a fee structure, a concentration profile, and a future version of yourself. If you buy the wrong thing, you do not simply lose money. You create the kind of discomfort that makes you sell at the wrong time. And in my experience, bad behavior destroys more wealth than bad analysis. So let me give this to you straight. There are broad global funds that let you own almost everything. There are international funds that protect you from the arrogance of believing one country will lead forever. There are dividend funds that look slower in the short run but can feel like a cash machine to the disciplined owner. There are broad American funds that have been extraordinary wealth compounds. There are momentum funds that lean into the market's strongest leadership. There are NASDAQ and technology funds that harness innovation. And there are semiconductor funds that have delivered absurd returns because chips became the toll road of the modern economy. Each one has a place, but each one also has a price. And the price is not only what the fund charges you every year, the price is also the volatility you agree to live with, the concentration risk you agree to carry. The temptation you agree to manage. The file opens with a comparison rooted in the last decade that is sensible because a decade is long enough to include multiple moods of the market. A one-year winner tells me almost nothing. A 3-year winner tells me a little more. A 10-year winner tells me the strategy had to survive more than one kind of environment that matters. Any fool can look brilliant in a single kind of market. What I want to know is whether the engine can keep running when the road changes. That is why I've always had respect for broad, low-cost exposure. Not because it is flashy, because it is hard to kill. A fund like Vexus, which owns thousands of non-American companies, reminds you of a truth many Americans dislike hearing. The United States is a magnificent market, but it is not the whole world. Capital has a way of embarrassing people who confuse dominance with permanence. You can own Taiwan Semiconductor, Samsung, ASML, Tencent, and thousands of other businesses through one instrument. You pay almost nothing for that access. The last decade gave roughly mid-single to high single-digit annualized returns. Not spectacular compared with what America produced, but that is not the point. The point is geopolitical humility. The point is not betting your whole financial future on one flag, one central bank, one political system, one valuation regime. Most investors say they want diversification until diversification underperforms for a while, then they want entertainment again. That is why most people never get the full benefit of diversification. They only like it in theory. Now take a step wider and you get something like VT, the total world approach. This is the set it and forget it dream that appeals to a certain kind of sensible mind. One purchase, thousands of companies, America plus developed markets plus emerging markets, very low fee, enormous simplicity, you own the world, and you go live your life. I understand the appeal. In fact, there is something wonderfully honest about it. It admits that nobody knows with certainty which country, sector, or style will dominate the next 15 years. So instead of pretending to know, you buy the productive machine of capitalism itself. That is a respectable way to invest. But let me also tell you its hidden truth. Even a world fund is still heavily influenced by the largest American companies because the world is market cap weighted. Size pulls weight. That means some people think they have escaped concentration when in reality they have only softened it. That is not a criticism. It is just the structure. You should always know what you own. And if you do not know what you own, then sooner or later the market will educate you. Now let me move to an ETF that many impatient investors underestimate, and I think that is a mistake. CG. A lot of younger investors hear dividend ETF and immediately assume old, slow, boring, second best. That reaction tells me they do not understand the difference between excitement and quality. A well-built dividend strategy is not just a collection of companies handing out cash like a polite grandfather. It is often a collection of profitable businesses with durable economics, cash discipline, and a management culture that has to respect shareholders in a more visible way. You get current income, you get growth. And if the fund is built properly, you get a sturdier emotional experience during market storms. In the material you gave me, South Carolina HD is long-term annualized total return. Over a decade sits above 12%, with a fee so low that it barely matters. That is not mediocrity. That is excellent. And it teaches a lesson people forget. You do not need the most explosive asset in the room to become rich. You need an asset you can keep owning. A slightly lower peak return, combined with lower behavioral error, often beats a theoretically superior strategy that you abandon in year 3 because you got bored or scared. That is one of the reasons I have always admired simplicity. Married to quality, the market does not only reward intelligence, it rewards staying power. And staying power comes from structures you can live with. Now let us talk about the broad American market, VTI and VO. If I had to choose two symbols that represent the modern investor's default language of reason, it would be those two. VTI gives you the whole investable American market, mega cap, large cap, mid cap, small cap. You own the giant businesses, the stable businesses, and a slice of the up-and-comers. It is broad, it is cheap, it is tax efficient, it has been a magnificent compounding machine. VU is a little more selective. It gives you the 500 giants, the elite club, the companies that became big enough, profitable enough, relevant enough to sit inside the benchmark everybody watches. The difference between them over long periods is not enormous. In the material you gave me, VU edges out VTI over the last decade. That does not shock me. Large winning businesses in America have an extraordinary run, and concentration in quality leadership has been rewarded. But I would caution you against treating that small edge like a revelation from heaven. What matters more is the principle underneath it. Both funds embody the same core truth: ownership of productive American enterprise at very low cost over very long periods has been one of the most forgiving wealth strategies available to ordinary people. Not easy in the emotional sense, but simple in the mechanical sense. That distinction matters. People say investing is complicated. Number investing is psychologically hard. Mechanically, much of it is simple. Buy good assets, pay low fees, add regularly, do not interrupt compounding. Do not act like every price move is a referendum on your intelligence. That sounds easy until fear enters the room. Then suddenly everyone wants a forecast. Now, the more aggressive side of the file is where things start getting exciting, and also where many people lose their balanced momentum. The S&P Momentum Fund approach represented here by ESMO fascinates investors because it appears to do exactly what common sense wants to do in bull markets: buy what is already winning. There is logic there. Markets exhibit trend persistence more often than amateurs appreciate. Leadership can feed on itself. Institutions crowd into strength. Capital chases what works. Momentum exists because human beings are slow to fully price change, and because success attracts attention, flows, and narrative reinforcement. That is the beauty of it, and the danger of it. A momentum ETF can outperform broad indexes over long stretches because it systematically leans into the market, strongest names in the numbers you supplied. It has done exactly that over a 10-year window, with returns materially above the plain vanilla S&P 500. But you must understand what you are buying. You are not buying calm. You are buying a faster horse that can be wonderful while the race is going your way. But if the track changes, fast horses throw you harder. This is why I tell people not to confuse a satellite with a foundation. Momentum can be a superb tool. It is a dangerous religion. The same is true, only more so when you move into QQQ, VGT, and SMH. Now we are entering the kingdom of concentrated technological progress. This is the part of the market that makes people feel intelligent in good years and stupid in bad ones. QQQ has been one of the great long-term vehicles for participating in American innovation outside the financial sector. The businesses it owns are not just companies. They are distribution systems for modern life software. Cloud infrastructure, digital advertising, devices, enterprise platforms, communication rails, data, semiconductors, and everything wrapped around them. If you believe the world will continue to digitize, automate, compute, analyze, and consume through connected systems, then QQQ makes intuitive sense. And over the last decade, the returns have rewarded that view in dramatic fashion. Then comes VGT, which says that broad growth is not enough. I want the pure technology stream itself, and then SMH, which says not merely technology, but the picks and shovels inside the digital gold rush, the semiconductor stack, the chip designers, manufacturers, and equipment providers that sit beneath the entire AI, cloud device, and automation revolution. Now, let me speak plainly. When a sector fund produces 10-year annualized returns north of 20%, and in one case above 30%, investors begin to hallucinate permanence. That is when danger enters. I understand why people feel seduced by these numbers. 20% annualized sounds like a miracle. 33% sounds like a crime scene. You run it through a compound calculator and your eyes widen. You start telling yourself stories about what $100,000 could become. You begin to resent every dollar you ever put into something boring. You begin to think diversification was a mistake. Prudence was cowardice, and concentration is the path of the enlightened. That is exactly how markets punish people. Because just when a sector proves itself indispensable, capital floods in, expectations rise, multiples stretch, and the future has to become even better than everyone already assumes. That does not mean these funds are bad. Far from it. It means you must buy them with the right psychology. Technology is not a fad. Semiconductors are not optional. Artificial intelligence is not imaginary. Digital infrastructure is not going away. But that does not mean every point of entry is equally intelligent. Nor does it mean a sector that led for a decade cannot go through a brutal multi-year stretch that shakes out weak owners. When I was younger, I learned a painful truth. A great asset bought with the wrong expectations can behave like a terrible asset, not because the business changed, because the owner did not understand the terms of the deal. The real deal in a concentrated growth ETF is this. You will likely get stronger upside when the theme is working. You will likely get sharper drawdowns when sentiment turns. You will likely feel brilliant in the good years and nauseous in the bad years. So before you buy, ask yourself a very unfashionable question. Can I live through the version of this investment that nobody markets? Can I own it after it falls 40%? Can I add after it falls 50%? Can I watch broad indexes recover before it does? Can I remain rational while the same commentators who praised it at the top call it dead at the bottom? That is the real test. Everybody wants the return. Almost nobody wants the path. And the path is what you actually live through. This is why so many people would have been better served owning VO the whole time than trying to outsmart the market with a basket of specialized ideas they did not truly understand. It is not enough for an ETF to have outperformed. You must also ask whether it outperformed in a way you can personally survive. That is one reason the title idea of something being better than VO can be both useful and dangerous. Useful because it prompts comparison. Dangerous because it suggests investing is a beauty contest with a winner and loser. That is not how serious wealth is built. The question is not what is better in the abstract. The question is, what role does this ETF play in a portfolio? What risk does it introduce? What behavior does it demand? And what kind of long-term owner is it designed for? VO is not obsolete because QQQ or VGT or SMH beat it over a particular decade. A sturdy truck does not become useless because a race car is faster on the right day. They are tools. The skill is knowing which job you are actually trying to do. If your job is to own a low-cost slice of dominant American enterprise and sleep at night, VO is magnificent. If your job is broader American representation, Vermont I is sensible. If your job is global humility, Vermont or VXUS deserve respect. If your job is combining income with quality and lower drama, South Carolina HD has merit. If your job is leaning into leadership, SMO is interesting. If your job is betting that innovation keeps outrunning the old economy, QQQ and VGT become tempting. If your job is expressing the conviction that chips remain the central toll booth of the digital age, SMH is the purest statement in the room. But the more specific the job, the more specific the risk. Never forget that. Now let me step back from ticker symbols and give you the deeper lesson, because this is where fortunes are actually made or lost. Investors love product selection because product selection feels like progress. What should I buy? Which ETF is best? What is beating? What? Those are easy questions to ask. Harder questions create wealth. How much will I save? How consistently will I invest? How will I behave in drawdowns? What percentage of my portfolio belongs in broad compounding vehicles versus concentrated conviction bets? What fee drag am I accepting? What tax drag am I creating? What is my rebalance protocol? How much of my plan depends on me being smarter than average rather than more disciplined than average? That last one matters more than most people realize. You do not need to outguess the market every year. You need to avoid self-sabotage for 20 years. That is a lower bar intellectually and a far higher bar emotionally, which is why most people fail. They want investing to flatter them. I want it to fund them. Those are very different priorities. One leads to performance chasing. One leads to ownership. One leads to endless changes. One leads to a written protocol. One leads to a portfolio built from envy. One leads to a portfolio built from fit. Now, because the material you gave me ranks these funds by 10-year annualized return, let me say something unpopular. Ranking is useful, but only if you refuse to worship it. A ranking tells you what happened. It does not tell you what belongs in your hands. That part depends on your age, cash flow needs, temperament, tax situation, and the role each fund plays inside a larger system. A young investor with stable income, a strong stomach, and decades ahead of him can justify meaningful exposure to growth and technology concentration. A retiree drawing income and protecting capital should think differently. A person whose job is already tied to the technology cycle should think differently again. A founder with stock options in one sector should not build his public portfolio as if he has no existing concentration. That is why personal finance is personal and portfolio design is contextual. When people ask me for one perfect ETF, I usually know they are still looking for a shortcut. There is no perfect ETF. There are only appropriate tools for a given mission. You do not build a house with one instrument. You do not build a fortune with one headline. You build both with a structure. Let me tell you what I like in practice. I like having a real core. By real, I mean boring enough that strangers on the internet do not praise you for it. I like broad American exposure. I like global awareness. I like low fees. I like assets that do not require constant reinterpretation. Then, around that core, if you understand what you are doing, I do not mind adding deliberate concentrations where the economics are strong and the secular tailwind is obvious. Technology has clearly had such a tailwind. Semiconductors have clearly had such a tailwind. Momentum has clearly had useful periods. Dividend quality has clearly earned respect. But I never want the exciting piece to become large enough that one narrative break can derail my life. That is the line. The point of wealth is not to maximize thrill. It is to maximize useful freedom, and useful freedom comes from compounding that survives your own emotions. Now let me say a word about fees, because they look small until they become large. People will spend weeks comparing two ETFs with nearly identical holdings, and then ignore a fee difference because it looks tiny. That is a mistake. In the file you gave me, most of the broad and sensible funds carry fees so low they are practically a rounding error. That is one of the miracles of modern investing. Ordinary people can access baskets of thousands of businesses for almost nothing. Do not take that lightly. High fees are one of the few reliable ways to mathematically underperform before the game even starts. If two vehicles offer similar exposure and similar construction quality, I prefer to keep more of my return. Always compounding is hard enough without paying unnecessary tolls. And while we are on the subject of tolls, let us talk about turnover and hidden costs. A momentum strategy often has to adjust. A concentrated sector strategy may behave differently in stress. A broad market fund can often simply keep letting the market work. The less forced motion there is, the more elegant the machine tends to be. That does not make every active tilt foolish. It simply means every tilt should justify the friction it introduces. Very few do. Another thing I want to rescue newer investors from is the idea that if they did not own the top performing ETF of the last decade, they somehow failed. That is nonsense. If you compounded at 8%, 10%, 12%, 15%, and did it consistently with meaningful savings, you are not behind. You are operating one of the most powerful wealth engines available to ordinary people. Most people are not losing because they picked the second best ETF instead of the first. They are losing because they save too little, switch too often, panic too fast, and abandon the plan before compounding has time to become visible. The first decade often feels underwhelming. That discourages people. The numbers look small relative to the effort, then the second decade starts looking different, then the third can look almost unfair. That is why wealth built through compounding often appears slow, then sudden. People envy the sudden part and ignore the slow part. I never do. The slow part is where the fortune is actually born. Now let me bring this home with a practical frame. Imagine your portfolio as a business. Your broad market funds are the factory. They are the reliable, productive base. Your global exposure is insurance against national arrogance. Your dividend quality sleeve is the cash drawer. Your growth and technology sleeve is the research lab. Your semiconductor position is the toll booth on a busy highway. Your momentum sleeve, if you use one, is the sales team pushing the hottest products while demand is strong. Each can be useful, but if you replace the factory with the research lab or the cash drawer with the hottest product of the year, you do not have a balanced enterprise anymore. You have a gamble disguised as strategy, and there is one more point I want to press. The last decade created unusual winners. It rewarded scale, software, semiconductors, digital platforms, and American leadership in a remarkable way that does not make the next decade identical. History repeats in spirit, not in costume. So use the record as information, not prophecy. Respect the winners. Do not worship them. Study the structure. Do not surrender your judgment. Let the past inform you. Do not let it hypnotize you. The investor who wins from here will not necessarily be the one who simply bought what did best last time. It will be the one who understood why it did best. What had to be true for that to continue, how much risk he was taking to assume that continuation, and whether his broader portfolio could survive being wrong. That is the part people skip because it is not exciting. But then again, most fortunes are built in rooms that do not look exciting. A final truth, when you buy an ETF, you are not just buying exposure. You are signing a behavioral contract, a contract that says, when this underperforms, I will still understand why I own it. When this falls, I will know whether to add, hold, or ignore. When another fund starts outperforming, I will not abandon my system just because someone else posted a prettier chart. That is the contract. Break that contract often enough, and even a great ETF cannot save you. Honor that contract for long enough, and even an ordinary one can make you wealthy. So if you want my answer to the question underneath the title, here it is. Yes, there are ETFs that have beaten VU, some by a little, some by a lot, but the better question is whether they are better for the role you need filled. Better for the life you are actually building, and better for the investor you are capable of being when the market stops flattering you. That is the question adults ask. And if you can answer it honestly, history does not need to repeat perfectly for you to do very well. You only need a sound machine, low friction, steady capital, and the temperament not to interrupt the process. That is how you build a fortune, not by chasing the best chart, by choosing the right engine, then refusing to jump off it every time somebody points to a faster car.